bring in Rebecca Walser to talk a little bit more about this. She is the president of Walser Wealth Management. Hey, Rebecca, it's really good to see you. So, the stock market has indicated over the last couple of days that it's really, really concerned about regional banks. Though the situation with Credit Suisse is different than SVB and Signature, it's kind of like part of a theme, right?
Absolutely.
But what concerns do investors have that's leading to the downturn that we're seeing?
So Credit Suisse is really another potential contagion, and it's back in the news this morning, down 20% in the last few days. And what happened with Credit Suisse, people don't really understand what's going on. The SEC actually called them on Wednesday, March the 8th, the eve of them releasing their annual report, and was concerned with some of the reporting from 2019, 2020, 2019 and 2020. And basically, they paused sending out their annual report for that reason. So that did not secure investors' fears at all. What's going on right now with Credit Suisse is there is a Riyadh, Saudi Arabia finance meeting that is happening right now, and Credit Suisse's largest and backer, basically, which is the Saudi National Bank, is basically saying they can't do anything else to help Credit Suisse out of this situation because they're at their regulatory 9.9% maximum investment. So that is rattling the markets that Saudi Arabia is not going to continue to help out or to backstop Credit Suisse any further than they already have. And that is bringing back into Europe now banking fears that are, of course, too fresh for us in the United States, considering what just happened with SVB on Friday, with, First Republic, with a lot of the banks that the freezing got traded on Monday. And still, we're starting to see substantial pullbacks on valuations because we're worried that this is a potential contagion issue. So that's really what's happening.
Rebecca, with interest rates potentially seeing a hike next week, could we expect to see stocks slide further?
It's really interesting. When the PPI data came out this morning, really positive to give Jerome Powell an out, right? Because he has been very clear as of when he was with the Senate Banking Committee in front of Congress last week, when he was basically very clear saying we have to be higher for longer. And the market did not like that. The market had its worst few days in a 2-week session. So this PPI data coming out so unexpectedly low is really a quiver and his tool that he could say we're going to pause, we're going to stop, we're not going to do. Of course, we won't find out until March 22nd, March 23rd, but he could do that. And the markets would normally indicate they believe that would happen by whipsawing to the positive when this PPI data came out. The fact that the markets are still down so greatly shows me that the market is starting to realize this is beyond the Fed, and this could be something that is indicative of a bigger potential global recession. And that's why the markets haven't gone to the positive yet. But yes, the markets definitely have reduced. We only have about a 45% expectation now that we will even see an actual rate increase on this next FOMC meeting.
So the producer price index data was released this morning. I want you to talk to people about, tell them what it is, because every week we got a report, right? And tell them what it is and what it means for inflation.
Yeah. So the PPI is the producer price index. It's the wholesale prices, right? CPI is what we pay at retail at the stores, but PPI is what our producers, our industrial producers, are buying their wholesale items at. And it was down 4.6%. We expected it to come in at 5.4. So it came in a lot year over year. That's what the year over year numbers. You're showing right here that it's down 0.1%. That's month over month. And not only that, but the January numbers were revised downwards from 6% to 5.7%. So we're seeing this trend of the prices at the wholesale are coming down, which is it's a good thing for inflation indications for all of us.
Rebecca, mortgage demand rose for the second straight week. Why are we seeing an increase in demand with the current state of volatility in mortgage rates?
So as the markets reacted to Powell saying that, rates were going to have to be higher for longer, the market really had a pullback. And once the market has a pullback, the market and the Fed are just, you cannot explain them rationally. But as soon as the market had a pullback, the yields actually dropped. So we had our 30-year drop from 6.79 to 6.71 last week. And that was enough to send week over week mortgage rates up by 7%. They're still down 38% year over year, but they were up 7% last week, and refis were up 5% last week. Those are down 74% year over year. So even though they're trending up as rates come down because of the Fed's comments, because the market is realizing the Fed's not going to be able to pull this off, they're going to have to pause or pivot. So that's when the yields start to come down, and that's when you see mortgage applications tick up a little bit.
Rebecca, breaking it all down for us. Thank you.
Absolutely.